Welcome back to the Deep Dive. You've handed us a truly fascinating and, I have to say, deeply researched stack of sources.
It's a big one.
It is. And it outlines what is, I think, easily one of the most consequential geopolitical pivots happening anywhere in the world right now. So our mission today is clear. We are diving deep into the Western Hemisphere.
Our own backyard.
Our own backyard to analyze this intense, high-stakes battle. I mean, it's a direct competition between the United States and China for everything. Influence, resources, strategic control across Latin America.
That's right. And if you strip away all the diplomatic niceties, the core theme of this source stack is really a dramatic geopolitical shift.
Yet a huge one.
And it's all rooted in a resource and strategic war.
Yeah.
The narrative structure the sources provide as well, it's absolutely damning for Washington.
How so?
For nearly 2 decades, the U.S. was just fundamentally distracted. Preoccupied by, counterinsurgency wars, complex policy in the Middle East, Central Asia. And during that time, the U.S. was, to use the source phrase, completely asleep at the wheel regarding its own neighborhood.
And while the regional hegemon was sleeping, a highly efficient, very quiet, and extensive economic campaign took hold.
The silent invasion.
That's what the sources call it, the silent invasion. And it wasn't just, small trade deals. This was structural integration. It touched everything from the lithium mines high in the Andes to the massive agricultural commodity chains.
Soy fields, beef producers in Brazil, Argentina.
Exactly. China moved in quickly, quietly, and just became the dominant economic partner in the region.
And that era of silent invasion fundamentally rewrote the economic map of South America. The shock of that realization in Washington is precisely what has prompted this extreme, high-pressure, and often confrontational reaction we're seeing now.
The loud eviction.
The loud eviction. That's the term for this new, aggressive U.S. policy. And it's all coalesced under a single defining strategic vision, the Donroe Doctrine.
Okay, so we need to spend some time defining this. The Donroe Doctrine. It sounds like a supercharged, maybe militarized update to a dusty old piece of U.S. foreign policy.
That's a good way to put it.
So what exactly is the philosophy here, and how drastically does it depart from the original 200-year-old Monroe Doctrine?
Well, the original Monroe Doctrine, going back to 1823, had a very specific, very narrow focus for its time.
Which was?
Europe, keep out. That was
Yeah.
it. It sought to protect these newly independent nations in the Western Hemisphere from being recolonized by European powers. It was about establishing the hemisphere as a distinct, exclusive sphere of U.S. influence.
Backed by the British Navy, ironically enough.
Exactly. But the Donroe Doctrine, it takes that concept, updates it for our 21st century great power competition, it militarizes the language, and it aims it squarely at Beijing.
So the message has completely shifted. It's gone from preventing European colonization to this very explicit, forceful declaration, China, get out.
Precisely. And the departure isn't just the target, it's the mechanism. The sources are so emphatic on this point. The U.S. is shifting away from its 20th century toolkit.
You mean things like development aid, preferential loans, soft diplomacy?
All of that. That whole toolkit just proved ineffective against China's, transactional checkbook diplomacy. So instead, the U.S. is using what the sources accurately call economic artillery.
Economic artillery.
Yeah.
That implied weapons designed to inflict maximum financial damage. What are we talking about specifically?
We are talking about tariffs, export controls, sanctions regimes, specifically secondary sanctions, and the weaponization of market access.
So really high-pressure coercive tools.
Exactly. They're designed to force nations in the hemisphere to calculate that the cost of keeping a deep economic relationship with China is higher than the benefit of staying integrated with the U.S. financial system. It's a mechanism designed to create instant, painful economic consequences for not complying.
Which, when you look at the source material, it leads us directly to the ultimate goal, right? Turning the Western Hemisphere into what they repeatedly call a closed fortress. It's not just about stopping encroachment. It's about building a protected, self-reliant regional bloc.
Absolutely. This concept of the closed fortress is fundamentally about geopolitical self-sufficiency. It signifies a radical shift away from that post-Cold War ideal of a fully globalized supply chain.
So the fortress model is about securing everything.
Everything critical. Energy, minerals, manufacturing, securing it all entirely within the politically friendly confines of the Americas, or at least with nations covered by specific U.S. strategic treaties. It's about building protective structural barriers, both physical and digital, around the entire region.
That sets the stage for a truly high-stakes deep dive. So for you, the listener, we are opening 3 major files today that illustrate the speed and, I guess, the necessity of this pivot.
And they are quite shocking.
First, the concrete evidence of the U.S. loss. This astonishing 40x trade explosion that shocked Washington into action. Second, the terrifying strategic threat that, necessitated a military response. The digital Panama Canal at Chancay Port, Peru.
A huge one.
And third, the high-stakes prize that drove the urgency. The battle for the Lithium Triangle in the Andes.
The velocity of change outlined in this stack. I mean, from a rounding error to a full-blown strategic confrontation in less than 25 years. That is what makes this moment so urgent for geopolitical analysis.
Yeah, let's unpack this. We have to start with the hard facts, because the data on the economic shift is really, it's the foundational evidence for the whole Donroe Doctrine.
Yeah.
Okay, we open the first file, and it is just raw trade data. And it highlights precisely why Washington's policy establishment, which had largely ignored the region for decades, suddenly moved from apathy to outright panic.
Right, and the comparison is so crucial for understanding the sheer magnitude of the shift. The sources refer to China's trade with Latin America back in the year 2000 as a literal rounding error in the global context.
Just insignificant.
Completely. The figure cited is roughly, $12 billion? Now, you fast forward to today, and that figure has just exploded.
The latest published statistics put that figure near, or maybe even a little over, $500 billion. $500 billion
Yeah,
annually.
and that is the astonishing number. A 40-fold increase. A 40x explosion in trade volume in less than 25 years. This isn't slow organic growth. This is a complete and violent realignment of economic gravity across an entire continent.
Unbelievable.
I mean, when a major power's trade volume with a neighboring region jumps by 4,000%, while the traditional regional power's trade just stays relatively stagnant, that is a declaration of economic victory.
And the immediate, inescapable consequence of this, financial conquest, is that China is now the indisputable #1 trading partner for South America.
South America as a whole, yes.
This isn't just, anecdotal influence. This is profound structural dominance, the traditional norm where the U.S. market served as the economic center of the Western Hemisphere. That's been irrevocably broken.
That's the critical point. For over a century, if you were a Chilean copper miner or a Brazilian soy producer and you wanted to secure financing or a guaranteed market, you looked north to New York or Miami.
That was the only game in town.
Exactly. That entire commercial and financial tether has been completely redirected. Their first call now. It's to Beijing or Shanghai.
So how exactly did this happen so fast? I mean, it wasn't a military campaign. The sources captured the essence perfectly. China invaded with checkbooks, not tanks. We really need to elaborate on the tactical mechanism of this economic invasion.
The Chinese strategy was brilliant in its simplicity and its effectiveness, because it addressed the immediate material needs of these developing nations without getting tangled up in political ideology. It was just pure pragmatism.
So what do they provide?
A guaranteed, massive offtake agreement for essential commodities. They bought the raw materials these nations specialize in, the soy that feeds China's huge hog population, the copper and iron ore that fuel its manufacturing complex, and the beef that satisfies its rising middle class.
So they essentially became the guaranteed buyer of last resort.
Yes.
Which offers incredible stability to agricultural and mining sectors that are, historically subject to these really volatile prices.
Exactly. But they didn't stop there. They didn't just buy the raw materials. At the same time, China poured massive conditional free investment into the infrastructure development that was desperately needed across the region.
So they weren't just buying the copper.
They were building the bridges to move the copper, the dams to power the refineries, the fiber optic cables to facilitate the transactions, and installing advanced 5G networks that leaped over older, less functional U.S.-backed systems.
Yeah. I wonder if we can illustrate the difference in approaches here. Because while China was, laying concrete and fiber optics, what was the U.S. doing? Why did its historical approach fail so spectacularly?
Well, the sources highlight a fatal misalignment of priorities. While China was delivering shovel-ready projects that led to jobs and immediate infrastructure modernization, the U.S., distracted by conflicts abroad, often engaged with Latin America by, and I'm quoting here, lecturing these nations on policy.
Right.
This typically involved conditional aid tied to often abstract goals like democracy promotion, rigid anti-corruption standards, or environmental regulations.
Which, while ethically laudable, did not address the immediate pressing need for roads and ports and power grids.
Exactly. So in a hypothetical scenario, right, A local government needs a new $100 million road to connect a vital farming region to a port.
Okay.
The U.S. might offer a grant for, say, $50 million, but it's conditional on the country restructuring its entire judicial system.
A huge, slow-moving process.
Immense. China, on the other hand, offers a $100 million loan payable in soybeans, and the road is built in 18 months.
That is a stark contrast.
It is. China offered commerce and immediate, tangible infrastructure with almost no political strings attached, or at least no visible political strings beyond ensuring future commodity flows. The U.S. offered complex, slow-moving aid conditional on internal policy changes. For nations eager for rapid development, the Chinese offer was just undeniably more compelling.
It was a pragmatic, transactional relationship.
Completely. And it sidestepped the paternalistic undertones often associated with U.S. foreign policy in the region.
And this leads us to the strategic implication that is driving the panic behind the Donroe Doctrine.
Yes.
The U.S. has lost its leverage.
This is the core panic in the Pentagon and the State Department. The source material uses this really powerful analogy to describe Washington's current predicament.
What's that?
The U.S. is now attempting to give geopolitical orders to tenants who are paying rent to someone else.
That's good.
I mean, if the primary source of national income, whether that's from lithium, copper, or soy exports, flows reliably and consistently to Beijing, then Beijing holds the real economic power and the resulting political influence, not Washington.
So if the U.S. threatens economic sanctions or to withdraw support, the response from a country like Argentina or Brazil is no longer compliance.
It's a shrug.
It's a shrug. They might say, look, we appreciate your concerns about our new telecommunications network, but our largest customer is China, and they just funded a massive dam project for us. We need that revenue more than we need your conditional aid.
The U.S. effectively forfeited its ability to command obedience or even significant influence through conventional economic means.
But wait a minute, though. The source material must acknowledge the immense internal cost that U.S. coercion will entail, right?
It does.
The only way to regain that leverage is to disrupt the current arrangement so profoundly that it forces these nations to choose the U.S., even if the U.S. is acting as the aggressor.
And that disruption is the Donroe Doctrine, a strategic initiative that seeks to make the cost of continuing a deep relationship with China higher than the cost of breaking it.
That is a huge shift in diplomatic stance. The era of gentle persuasion is over, replaced by what looks like brute economic force designed to isolate Beijing.
And this is where it gets really interesting, because that flood of Chinese money led directly to concrete long-term strategic vulnerabilities that pose a direct threat to U.S. national security interests.
So when we transition from economic loss to strategic threat, we have to look beyond just the money flows, right? We have to examine the physical assets that Chinese state-owned enterprises have acquired or built in the region.
Exactly. And the most vivid, the most urgent example of this threat is the massive infrastructure project unfolding on the coast of Peru, the Chancay Port.
Okay, Chancay Port. This facility is being called the Digital Panama Canal.
It is.
Which immediately suggests it's not just some commercial pier. It sounds like a geopolitical checkmate against the U.S.-controlled global logistics system.
It is absolutely intended to be a checkmate. It's designed to shift maritime trade patterns away from U.S. spheres of influence. Chancay is being developed and will be majority-owned and operated by the Chinese state-owned shipping giant, COSCO Shipping.
A state-owned enterprise.
A massive one. The facility itself is enormous, a deep-water megaport described in the source material as potentially becoming the Shanghai of South America.
Let's detail the critical technical aspects. Why is that specific deep-water capability so critical in modern global logistics?
It all matters because of the trend toward these massive container ships, the post-Panamax vessels. Since the Panama Canal completed its expansion in 2016, ship sizes have just kept growing and growing.
And the old ports can't handle them.
Many existing South American ports can't. They were built decades ago to older standards. They're too shallow, or they lack the turning radius necessary for these colossal vessels. So what happens?
Transshipments.
Exactly. South American goods often require complex, time-consuming transshipments, usually involving stops in Central America or U.S.-aligned Caribbean hubs, where smaller vessels ferry the cargo.
So Chancay's depth allows these colossal ships, I mean, we're talking ones that carry 20,000 containers or more, to dock directly in Peru, fully loaded.
Correct. The moment Chancay is fully operational, it creates a direct, uninterrupted shipping line from the Peruvian coast to Asia, particularly to China.
And this route completely bypasses U.S.-controlled choke points.
It bypasses the Panama Canal. It avoids established U.S. maritime insurance and routing standards. It creates a whole new center of gravity.
And what is the staggering immediate economic threat this poses to U.S. dominance?
It fundamentally reduces the cost and time required to move South American commodities to the Asian market. The sources estimate that this facility alone could cut shipping times by weeks for routes between South America and Asia.
Weeks. That's a massive advantage.
It's a game changer. That speed and efficiency makes South American exports dramatically more competitive when they're headed to China, which deepens the economic integration between the two partners, and it actively marginalizes established U.S.-controlled shipping lanes in the Pacific. It decentralizes the traditional logistics system that has historically centered around U.S. ports.
Okay, so now we get to the core of the Donroe Doctrine's urgency. The Pentagon's specific concerns, the sheer size and the state ownership immediately raised the dual-use warning.
This is the chief concern, and it's emanating directly from U.S. Southern Command. Any massive infrastructure project, especially a deepwater port built by a state-owned entity with ties to Beijing, is automatically flagged as having a dual-use profile.
So it's a strategic assumption.
It is. The assumption is that the facility has both commercial utility and military potential.
Walk us through what dual use really means in this specific high-stakes context.
The source material illustrates the difference powerfully. Today, the port moves commercial goods, Peruvian avocados, blueberries, minerals.
Right.
But that same deep water berth, equipped with advanced cranes, integrated communications networks, refueling capacity, and secure logistics hubs. It could very easily be configured tomorrow to support and sustain the deployment of the Chinese Navy.
So we're not talking about a full-blown naval base, necessarily.
Not at first. But the facility provides a massive, pre-positioned platform for logistics support, far from China's territorial waters. It's about giving them reach.
And this is more than just refueling, right? It's about providing logistical resilience.
Exactly. For military operations, logistics often dictates strategy. A permanent, secure, deep-water port, even a commercial one, allows a navy to sustain prolonged operations far from home. And for the Pentagon, the geographical significance here cannot be overstated. They view Chancay's location as deep into the red zone.
Let's clarify that term. It means the primary adversary is operating at an alarmingly close proximity.
It means the U.S. allowed its chief competitor to establish a base of operations on its own doorstep. The perception is that the U.S. allowed a critical multi-billion-dollar strategic asset to be built by its rival within the Western Hemisphere.
It's a physical, concrete symbol of the erosion of U.S. dominance.
It is. Chancay offers China a strategic forward presence that the U.S. previously believed was impossible for a near-peer competitor to establish so close to its own territory. And that justifies the extreme coercive measures of the Donroe Doctrine.
The sheer proximity and the dual-use potential are clearly driving the urgency. If logistics and power projection are one strategic threat, the other, equally existential threat is about fundamental resources. The future of energy itself hangs in the balance.
The second major strategic threat revolves around why China was willing to spend hundreds of billions in the first place.
Right.
And that is the immense value locked away in the Andes Mountains. Lithium.
The critical element for the global energy transition. We hear constantly about the scramble for lithium, but this is a uniquely concentrated geopolitical problem.
It is. The sources focus on what is known as the Lithium Triangle. This region is comprised of the high-altitude salt flats shared by three distinct nations: Chile, Argentina, and Bolivia.
And the statistics here, much like the trade numbers, are globally significant.
How significant?
Together, these three nations are estimated to hold at least 60% of the world's currently known recoverable lithium reserves.
60%?
60%. This concentration means that whichever power controls the extraction, the processing, and the offtake agreements in this triangle effectively controls the global pace of the energy transition. Let's explain the vital strategic importance of lithium beyond just EVs. Why is this one metal so central that it dictates global geopolitical strategy and justifies a doctrine of eviction?
Well, lithium is just indispensable for the 21st century economy. First, you have the electric vehicle revolution. It relies entirely on lithium-ion batteries. Without a massive, secure supply, the global automotive industry cannot meet its transition deadlines.
Okay, that's the obvious one.
Second, and equally vital, is the green grid. You cannot stabilize intermittent renewable energy sources, solar and wind, without vast grid-scale battery storage, which also uses lithium.
Yeah, I'm the third piece.
National defense. Modern military operations, from advanced drones to communications equipment and portable power for soldiers, all require lightweight, high-capacity energy storage. Securing lithium is securing economic competitiveness and military capability at the same time.
So what is the situation on the ground that alarms Washington regarding current control?
The alarming reality is twofold. First, Chinese firms moved in early and aggressively. They secured the majority of extraction rights, often through long-term joint ventures with state-owned enterprises in Bolivia and Argentina.
Okay, so they control the extraction.
But second, and perhaps more crucially, China dominates the processing phase. Even if the U.S. were to extract the raw lithium itself, it lacks the domestic capacity to refine it into battery-grade chemical compounds, things like lithium hydroxide or carbonate.
So it's not just about digging it out of the ground, it's the whole chain.
The entire chain. So even if the U.S. breaks China's hold on the salt flats, they are still dependent on Chinese refineries. That is a textbook supply chain
A
vulnerability.
complete vulnerability.
And this dependence leads us back directly to the core U.S. policy goal inherent in the Donroe Doctrine. It is not just about the political win of keeping China out. It is fundamentally about securing the raw material supply chain for American reindustrialization. The U.S. needs a captive, reliable, and politically aligned source of these critical minerals to execute its own domestic clean energy policies.
The sources make a truly consequential claim, arguing that if the U.S. gets locked out of the Lithium Triangle, the entire green transition is dead on arrival. That's a massive assertion that needs some context.
It's grounded in industrial reality. The U.S. and Europe are currently building these huge gigafactories, enormous battery production facilities, but they rely on secure raw material inputs.
And if 60% of the world's key raw material is locked up by Chinese-controlled entities,
Then the flow of that material becomes a geopolitical tool wielded by Beijing. U.S. reindustrialization plans for the 21st century, especially around EVs and grid storage, will just collapse under their own weight if they can't secure the lithium at a reliable price and volume.
So this is why the sources rightly frame the situation not as a diplomatic row, but as a resource war disguised as diplomatic tension.
Exactly. The stakes are existential for Western economic independence.
Okay, so we have a $500 billion economic invasion, a direct strategic logistics threat at Chancay Port, and an existential resource threat in the Andes. The U.S. is now facing a rival that has built structural advantages right next door. So what does this all mean for the execution? How exactly does the U.S. plan to use the Donroe Doctrine to evict a tenant who controls the ports, the energy, and the infrastructure? The U.S. faces a fundamental strategic limitation here, one we established early on. Washington cannot simply pivot and instantly outspend China in Latin America.
No.
That would require hundreds of billions of dollars and years of political alignment and infrastructure investment. That ship has sailed.
Correct. The U.S. recognized that if it couldn't win the transactional bidding war, the checkbook invasion, it had to deploy an entirely different kind of weapon. The old playbook of aid packages and soft power is retired. The sources are clear that the solution is now coercion.
This sounds brutal and politically risky. What is the new playbook, and what is the strategic philosophy underpinning this shift to coercion?
The philosophy is one of forced binary choice. The playbook is exceptionally blunt, shifting away from partnership toward enforcement. You are either with us or you are against us.
That's simple.
That simple. The strategic calculus is that the global economic landscape is being sectioned into two camps, and the ultimate irresistible weapon held by the U.S. is guaranteed access to the wealthy U.S. consumer market and the U.S. dollar financial system.
So the carrot of development aid is replaced by the stick of market access withdrawal.
Exactly.
This means the U.S. is explicitly using its regulatory and financial dominance to make working with China prohibitively expensive for Latin American firms and governments.
That is the core mechanism of the Donroe Doctrine's economic artillery. And we can detail two specific high-leverage coercive tools mentioned repeatedly in the source materials that the U.S. is preparing to use, starting with the immediate high-pressure tool aimed at its closest neighbors.
The USMCA reviewed the trade agreement between the U.S., Mexico and Canada.
Precisely. The USMCA trade agreement contains a mandatory 6-year review scheduled for 2026. This review provides the perfect non-military opportunity for the U.S. to apply immense structural pressure, specifically targeting Mexico's relationship with Chinese manufacturing.
Okay, let's break down that pressure point. Why Mexico, and how would China attempt to use Mexico as a bypass for U.S. tariffs?
This is almost entirely focused on the automotive and advanced manufacturing sectors. China, facing increasingly high U.S. tariffs and export controls on goods shipped directly from Asia, seeks to use a third country, Mexico, as a logistical workaround.
A backdoor.
A backdoor. They ship Chinese components, raw materials, or partially finished goods to Mexico where they are assembled or lightly processed. The finished product is then theoretically claimed to have North American origin under USMCA rules, allowing it to enter the U.S. market tariff-free.
And that strategy completely undermines the entire U.S. policy goal of friendshoring and securing a North American manufacturing base.
Absolutely. So the threat the U.S. is preparing to deploy is therefore crystal clear. If you, Mexico, allow Chinese firms to use your territory as a backdoor to bypass our tariffs and undermine North American rules of origin, we will levy punitive tariffs on you.
Wow.
The U.S. can use specialized clauses related to national security or non-market economies to justify the pressure. And this threat is existential for Mexican manufacturing, which relies on frictionless, preferential access to the U.S. market for the majority of its economic activity.
So the U.S. is saying your preferential trade status is conditional upon your geopolitical alignment. Choose deep Chinese investment or guaranteed U.S. market access. That's a huge strategic leverage point.
It's massive.
So what is the second major coercive tool?
Yeah.
The one aimed deeper into South America, potentially targeting nations less dependent on the USMCA.
The second tool is the aggressive and expansive use of secondary sanctions. This is perhaps the most powerful and feared piece of economic artillery in the U.S. arsenal.
How do they work?
These sanctions are not imposed directly on an adversary like China. Instead, they target third parties, South American firms, financial institutions, or even government agencies that continue to conduct substantial business with specific Chinese entities targeted by Washington.
This is essentially weaponizing the global U.S. dollar financial system itself.
That is precisely what it does. The U.S. Treasury, through its Office of Foreign Assets Control, OFAC, controls access to the dollar clearing system. So if the U.S. imposes secondary sanctions on a large Argentine infrastructure firm, for example.
Because they're working with a Chinese state-backed company.
Right, maybe one linked to the military, which ties back to the Chancay dual-use threat. The consequences are immediate and catastrophic. That Argentine firm is instantly cut off from the U.S. financial system.
Explain the ripple effect of being cut off. What does that mean practically?
It means they cannot process payments in U.S. dollars, which is the currency of choice for, 90% of global trade. They can't conduct transactions with any U.S. bank, and critically, non-U.S. banks, major European or Japanese banks, will also refuse to process their transactions or risk being sanctioned themselves by the U.S.
The targeted firm is just isolated.
Completely isolated. Their assets potentially frozen, and their ability to function in the modern global economy is crippled.
So the U.S. doesn't even have to sanction the government. They just have to sanction a few crucial commercial partners to make the Chinese relationship toxic.
And the sources suggest these sanctions will be aimed specifically at firms dealing with Chinese defense entities, directly linking this economic coercion back to the military concern, the dual-use threat at Chancay.
It's an ingenious and brutal mechanism of economic warfare.
It is. It is designed to clean out the perceived adversary from the region's critical infrastructure and strategic sectors. If the cost of maintaining a relationship with a Chinese entity, a cost measured in the isolation from the global dollar system, is too high, those South American firms will be compelled to break those ties instantly, regardless of what their own governments might prefer. The Donroe Doctrine essentially turns private companies into de facto enforcers of U.S. foreign policy.
But this aggressive posture of forced choice and coercion, it carries a massive inherent risk, one that could backfire spectacularly. What is the high-stakes gamble the U.S. is truly making here?
The risk is simple, yet potentially devastating to long-term U.S. interests. If the U.S. pushes too hard, if it applies tariffs and sanctions indiscriminately or without sufficient diplomatic finesse, these countries might not simply fold and return obediently to the U.S. orbit.
What's the alternative?
The sources highlight the acute danger that they might respond by choosing to formally join BRICS or solidify their alignment with that bloc, effectively closing the door on the U.S. market and the dollar system forever.
BRICS, of course, being the geopolitical and economic bloc, increasingly led by China, that is actively seeking to build an alternative to the Western financial order.
An alternative that particularly wants to bypass the U.S. dollar's dominance.
So if the U.S. employs the stick too severely,
It could inadvertently accelerate the very decoupling it is desperately trying to prevent, pushing key nations like Brazil, the massive economic engine of South America, into a formalized, institutionalized anti-U.S. bloc, would legitimize the alternative financial systems BRICS is trying to establish and potentially cut off the U.S. from that 60% share of critical minerals permanently.
it is a massive high-stakes gamble. It uses short-term economic leverage that could result in long-term geopolitical disaster.
And the U.S. is betting that market access to North America is a more compelling and immediate need than Chinese capital.
But as we established in Section 1, that assumption failed spectacularly over the last 20 years. They are banking on fear, not on shared values.
And that's why the coming years, particularly the lead up to and the actual 2026 USMCA review, will be the true test of the Donroe Doctrine. We will see whether coercion succeeds in bringing the hemisphere back into the fortress, or whether it simply hastens the development of a fully decoupled South American bloc. So we must step back now and synthesize the broader strategic verdict that's derived from all this source material. The sources emphasize that this local battle in the backyard is merely the most acute, the most urgent evidence of a much larger foundational global shift in economic organization.
Meaning the era of unfettered, geographically diverse global trade is fundamentally over.
It's over, correct. We are now decisively entering, if not fully inhabiting, the era of regional blocs. Major global economies, the U.S., China, the EU, are retrenching their supply chains into politically aligned, geographically clustered spheres.
And the U.S., using the Donroe Doctrine, is simply formalizing and defending its own necessary bloc.
Exactly, and that perfectly reiterates the core thesis we started with. The Western Hemisphere is being structurally reshaped into a closed-loop of fortress, designed to be strategically self-sufficient and secured entirely against rival influence, especially in critical sectors like high-tech manufacturing, energy, and logistics.
This closed fortress is the new strategic reality. For you, the listener, the crucial takeaway is how this dramatic redrawing of the map translates into tangible business, investment, and strategic implications. We need to look at the practical playbook that arises from the Donroe Doctrine.
Right. If the map is being redrawn, where does the smart money flow in this newly protected fortress?
Let's translate this strategic reality into the specific economic and investment implications, drawing directly from the playbook outlined in the sources.
Okay, first and foremost, you need to follow the trend of friendshoring. This means aligning your investment and your business strategy with companies that are actively building resilient supply chains within the political fortress, often backed by substantial government incentives like the Inflation Reduction Act or other domestic manufacturing support.
What does that look like on the ground for an investor or a business executive?
It means focusing heavily on companies building factories, assembly plants, and component suppliers in Mexico, Canada, and the United States. The political mandate is explicit and backed by trillions in capital. The supply chain is coming home, or at least coming into the tightly controlled North American economic bloc.
So companies that rely heavily on manufacturing in East Asia and lack a robust North American footprint, they're facing structural, permanent headwinds.
They are. While those investing in the USMCA region are aligned with the new strategic reality, we should anticipate a sustained, perhaps decade-long, infrastructure and manufacturing boom across the Americas, particularly in sectors like high-tech components, EV batteries, and pharmaceutical supply chains, all moving away from Asia.
Okay, that makes sense. What's the second implication?
The second key implication relates directly to the resource war we detailed, the battle for lithium and other critical minerals. The playbook suggests seeking out strategic miners.
Which miners are strategic in this new reality? The ones in the Lithium Triangle or the ones that are politically safe?
Both, but with a strong emphasis on political security. We need to look for lithium and copper miners operating not just anywhere, but specifically in treaty countries, nations with deep pre-existing trade and security alliances with the U.S.
Okay, so which countries are those?
The sources specifically named Canada, Australia, and Chile as key nations that the U.S. must protect both diplomatically and financially to secure its supply chain.
Wait a minute. Canada and Australia are obvious Western allies.
Yeah.
But Chile is right there in the Lithium Triangle, adjacent to the more, politically volatile parts of Argentina and Bolivia.
Yeah.
Why is Chile treated differently?
That goes back to the stability we mentioned earlier. Chile has a strong, mature institutional history robust rule of law, stable property rights, and establish bilateral trade agreements with the U.S. Investing in extraction there is seen as having a much lower political risk profile than investing in Bolivia, for instance.
Where the government has historically preferred strict resource nationalism.
And state control, leading to high contract uncertainty. If the U.S. is forced to prioritize which part of that 60% of global lithium it can secure, it will prioritize companies operating in the most politically stable and diplomatically aligned jurisdictions first.
So we're looking for miners who have a distinct geopolitical advantage by operating inside a friendly or protected jurisdiction. They're effectively insulated from the Donroe Doctrine's pressure tactics because they are deemed essential to the fortress's survival.
Exactly. They are strategically vital assets. The final component in the playbook relates directly to the increase in geopolitical tension itself, defense, and logistics spending.
This speaks to the necessary enforcement arm of the loud eviction.
It has to be enforced.
If the U.S. is forcing China out, that requires a physical and intelligence enforcement capability.
It absolutely does. As tensions continue to rise in the backyard, as the U.S. enforces customs compliance related to USMCA, forces the issue at ports like Chancay, or monitors the movement of resources, the U.S. Coast Guard, Navy, and intelligence budgets for southern operations will see a sustained, significant increase.
So we should anticipate a proportional rise in spending on naval assets.
Naval assets, intelligence gathering programs, regional security cooperation, all aimed specifically at neutralizing the dual-use threat and monitoring Chinese activity in the hemisphere. It will far exceed the minimal allocations of the past 2 decades.
So the transition from a passive trade relationship to an aggressive geopolitical containment strategy has profound practical investment implications. It favors companies and sectors that operate securely inside this developing Fortress America.
The map is not just being redrawn, it is being violently enforced right now.
And that's the directive for the astute learner. Ensure your understanding of global logistics, your investment portfolio, and your business strategy are fully aligned with being inside that fortress, not exposed to the economic artillery being fired outside it. #outro.
So we have systematically dissected the economic reality of the 40X explosion, the strategic threats posed by logistics and resources, and the aggressive mechanism of coercion known as the Donroe Doctrine. But we have to conclude with a final, provocative thought that encourages critical reflection.
One that touches on the deeper geopolitical and ethical dilemma this U.S. policy creates for the leaders of Latin America.
It's a classic, agonizing dilemma. Long-term geopolitical stability versus immediate economic modernization.
So if you were the president of a powerful South American nation like Brazil or Colombia,
you would be caught in this trap perfectly. On one side, China is your biggest, most profitable customer. They're buying immense quantities of your core commodities, providing immediate revenue and funding essential, shovel-ready infrastructure investment.
all good things for your country.
On the other side, the U.S., your historically dominant and geographically essential neighbor, is offering guaranteed, stable market access and integration into the global Western financial order, but with the immediate looming threat of devastating secondary sanctions if you continue deep cooperation with Beijing.
So you're forced to choose the immense short-term gain from Chinese capital, which modernizes your economy quickly and without ideological strings.
Or the long-term geopolitical and financial stability derived from deep integration with the U.S., which comes with mandatory geopolitical alignment.
The question you must mull over is this. From the perspective of a sovereign nation, what short-term gain is truly worth the long-term geopolitical risk of choosing the rising but volatile, geographically distant power over the established, geographically essential, but newly coercive neighbor?
And is the U.S., through the Donroe Doctrine, justified in sacrificing the sovereign economic rights of its neighbors in the name of national security? Or is it, through this coercion, simply repeating the errors of the past, alienating them forever, and inadvertently accelerating the rise of a truly separate, China-led trade bloc? That decision, made in dozens of capitals across the hemisphere over the next few years, will dictate the structure of global power.
A genuinely fascinating and high-stakes gamble indeed. Thank you for joining us on this deep dive into the Donroe Doctrine and the strategic battle for the backyard. We encourage you to continue exploring these crucial pivots in global strategy and economics.